welcome back to the Self-Educated Economist channel. I normally do whiteboard videos where I've got a whiteboard to articulate my thoughts and tell you what's going on, kind of show you pictures and things of what's going on in the news or financial realm. But today we're going to do it a little bit different. Quite a bit happened last week. We had the Federal Reserve had their emergency meeting in which they came out saying that they were going to be more hawkish. They were going to try not just allow the balance sheet to run off, but they were going to try to implement quantitative tightening, which is selling the assets that they own, that they've acquired on their balance sheet. In other words, they want to shrink their balance sheet and get rid of the treasuries and mortgage-backed securities which they bought. And then we've got the yield curves are starting to flatten and possibly come to an inversion before long. They said at one point the difference between a 2-year and a 10-year was only about 9 basis points in the market the other day. So a lot to talk about, and why this matters is, well, as the Federal Reserve starts its quantitative tightening and people see that the Federal Reserve doesn't have their back anymore like they have in the past, and the stock market's been going down, and you can look and see that it's been on a downward trend all week as far as that part goes. There's just a lot going on right now. They were talking about starting the rate hikes in March, and they also said earlier in the year they wanted to do 4 rate hikes this year. Now they're talking about doing something like 7 or 8 by next year. So yeah, there's a lot going on. I know people ask and they want to know what the difference between why the interest rates going up matters. And honestly, the Fed can only control the short end of the curve. They can only control the 2-year, the 1-year, the short-term T-bills. They've got more of a handle on that side. The 30-year is pretty well independent. It does what it wants to as far as the market. People buying and selling. But we'll go over why that quantitative tightening is going to make such a profound difference on the stock market. They were buying back in November when they started tightening. They were buying something around to the tune of $130 billion per month of assets, and these assets included the 30-year Treasury. They included mortgage-backed securities and some equities, municipal bonds, various different things they were buying. And the Fed isn't actually central. It's the central bank of the U.S., but it's not actually central. They don't do monetary policy. They don't create money. The only way they can create money is if the Congress actually sends out stimmy checks like they did back in 2020, and then you can say the Federal Reserve is helping print money. But see, money is created by the commercial banks, and that's your Bank of America, that's your JP Morgan and Chase, that's your local credit unions. When they extend loans, that's when money is created. And whenever those loans get paid back, that's when money is destroyed. With the inflation now, like it has been, you can see this. There's a chart that shows how the amount of lending going on, and ever since 2020, when the government started deficit spending and sending checks to everyday Americans, that's when the banks stopped a lot of lending. They slowed up. They ain't creating as much money and everything. So trying to help keep inflation in the market. But as we all know, with the CPI print of 7.5% for January, even after they changed the way that they calculate the CPI, the CPI print just keeps going up and up and up. And the way that the Federal Reserve stopped this back in the day was Paul Volcker in 1981 had to take interest rates to 18% in order to get get inflation under control, which put us in a small recession for a couple of years. Honestly, the Fed's got themselves backed into a corner. Like I said, they're not central. They only can. They want you to believe that they are, and they want you to believe the Fed makes a big difference. But honestly, it really doesn't. There was a study done on quantitative easing where they buy the bonds and things and mortgage-backed securities, and it showed that with $600 billion spent, they had only moved the needle maybe 15 basis points, 0.15% on the 30-year notes. So really, they're not really doing anything. It's more or less they're trying to get the public and these asset managers to believe that these big hedge fund managers and asset managers to believe that what they're doing matters, so that they can manipulate expectation policy, that you can expect this to happen or that to happen because the Fed said they would do this. Now here's the big conundrum: are they going to let the market crash? Because they're to the point to where they can either raise interest rates or they can backstop the market. They can either buy more mortgage-backed securities and treasuries, or they can sit back and let the market crash and raise interest rates and get the inflation down. From what I can understand and from what most people know, with the inflation, with the price of everything going up, that's about kryptonite for any politician or political party. They don't want inflation on their watch, but they also don't want the stock market to crash. And the reason they don't want the stock market to crash is when the stock market crashes and loses value, then people's pension funds lose value. And when those pension funds can no longer get the returns they need out of the stock market, then people don't get the pensions that they were once promised. So either way they go, it's a catch-22. Either way they go, they're going to have one problem or the other. We're either going to have inflation running rampant, as far as the CPI print goes, or we're going to have the stock market come crashing down. And at this point, I would basically call it a correction instead of a crash. But it's with all the volatility and with everything going around, people just kind of sitting around wondering what the Federal Reserve is actually going to do. What will they do? So I know a lot of the tech stocks have been going down, and like I said, the S&P 500 has been on a downward trend all week. It comes up and back down some during each trading day, but the actual trend, if you sit back and pull it out for a week or two, the actual trend is going down. So are they going to let the stock market crash and let people's 401ks and pension funds and let corporate paper go in the tank? Or are they going to and then raise interest rates, or are we going to let inflation run rampant and then prop up the stock markets? They can't do both. So as the old saying goes, they've painted themselves into a corner. Later on today, I intend to do another video on energy, and we'll talk about fuel prices and how much they've went up over the past couple of years, and really why this matters. A lot of people don't connect the dots between energy and the economy, so here in a little while we'll do another video on that, and hopefully we can open some eyes, get the understanding of what's actually going on when oil prices go up to $90 and $100 a barrel, and what's causing it. There's a lot of different things at play that's causing it. So here in a little bit we'll do a video talking about that, but if you would please, if you want to see more content like this, hit the like and subscribe button and ring that little notification bell at the bottom of the screen there, and I greatly appreciate it. Stay tuned. We'll talk about what the Federal Reserve is doing. some this week. I know they're going to have another meeting in March. But if the stock market keeps going down, will they have another meeting? Will they do something about it? Who knows? All we can do is sit back and watch and see what the traders think on Monday when the stock market opens back up, and go from there.